to know about today. At number 10, spending, Dom.
And we're going to go to number 9, and Novartis, the pharmaceutical maker, reported second quarter profit that declined less than analysts forecast. The Swiss company was helped by sales of new products treating multiple sclerosis and cancer. Josh.
Yeah, number 8, eBay, the company's stock on the rise after reporting second quarter sales and profit that beat analyst estimates. They experienced a boost in U.S. consumers shopping for new items on eBay, Betty.
And well, at number 7, Southwest Airlines, guys, the biggest low-fare carrier, reported second quarter profit up over 40% from last year. The airline's revenue also topped analyst estimates. We're going to be speaking with the CEO, Gary Kelly, about those results in just a few moments.
And next up, United Health, the largest U.S. health insurer, boosted its profit outlook for this year. That comes as more Americans are enrolling for government-backed Medicare and Medicaid policies. Josh.
Number 5 is Google. We've got our eyes on the tech giant as the company reports earnings after the bell today. This comes the same week as Google veteran Marissa Mayer defected to Yahoo, Betty.
A big hit for Google. Well, number 4, Credit Suisse, Switzerland's second biggest bank, plans to sell 2 private equity units in its asset management division due to uncertainty over the Volcker rule. Credit Suisse has had to boost capital amid Europe's worsening debt crisis. Dom?
Yeah, number 3 is Nokia, the struggling smartphone maker, actually surging in the pre-market, reporting sales of its Lumia mobile handset beat some analyst estimates. However, Nokia did say that losses for its handset business will stay on the same level as they did last quarter. Alex?
Microsoft coming up next, the software giant reporting earnings after the close of trading today. Analysts expect to see lackluster sales growth due to slower demand out of China, the world's largest PC market. Betty?
And your number 1 stock to watch this morning, Morgan Stanley. The banking giant reported a 50% drop in earnings this morning that missed analyst estimates. Revenue from trading stocks and bonds declined the most among Wall Street banks. The bank also announced 700 job cuts by the end of the year. More cost cutting. Josh is down on the floor of the New York Stock Exchange as we head towards the opening bell. Josh?
Yeah, hey there, Betty. Well, you saw U.S. stock futures rising, signaling the S&P 500 was going to extend this 2-day rally, maintaining those gains even after initial jobless claims. They've exceeded forecasts. Investors, they remain focused on those better than estimated earnings. But you hear the opening bell, so let's get a quick check on the major indexes. The S&P 500 basically opening flat here. The NASDAQ opening up about 0.6%, and the Dow Jones Industrial Average actually down about 2 points right now. Now, you heard me talking earlier to Keith Bliss of Catone & Company. In terms of the levels he's going to be watching today on the S&P 500, it's 1390 on the upside. If you were able to get through that, he said, you'd retest 1409, the recent high in May, Betty.
All right. Thank you, Josh. Josh Lipton down at the New York Stock Exchange. We are back with some final thoughts with Tom Lee as we're getting started here in the trading session, the chief U.S. equity strategist at J.P. Morgan. And Tom, let's talk a little bit about some of the sectors that are in your sort of domestic-oriented picks. And we talked about financials, but another one that has shown up is airlines, interestingly enough. And Southwest Airlines is one of the stocks in your picks. Why airlines?
It's ironic, right? Because I think when people historically think of airlines, they think of them as chronic money losers. Now, we've got a very experienced airline analyst, Jamie Baker, who covers the space, and he really sees this group very differently. He thinks they've really structurally changed. You know, they're an industry that's capable of making money through the cycle, and they are benefiting from, number 1, low gasoline prices or low oil, and actually pretty good demand because, it's a tight market and there's decent pricing. So it really, oddly, could be a group that works pretty well.
So basically what you're saying is they've got their costs in line.
Yes, for the first time probably maybe in the industry's unregulated history, yes.
Okay.
Now, Tom, you mentioned the benefit, this is Alex, to airlines due to lower oil prices, but you already mentioned that oil prices could see a pickup due to higher demand in the U.S. So then what happens to airlines then?
Well, I'd say that when I think about oil prices, I'm probably more thinking, you're going to be worried at 130, 140, 150. I think Brent could make a move to maybe over 100, 110 or so, but really the 150-ish level is where you start to see problems.
Tom,
we're a long way from there.
Well, Tom, I'm an optimist by nature here, but let's talk about what the possible pessimistic scenario could be. You're an optimist about where the target is. What derails your theory? What derails your targets for the S&P? What can happen here between now and the end of the year?
Well, there's a lot out there, actually. As you know, if you think about it, we're 50 points from my target. 50 points down is 1325, and I'd say that the street consensus would think it's easier to go to 1325 first. I think there's a lot of risks. I think if China isn't able to sort of grow faster in the second half, that presents a big problem for investors thinking about global growth. I think if Europe flares up again, that's another huge problem. And in the U.S., a lot of this is hinging on housing, so if we start to see a momentum waning on the U.S. housing recovery, that would pose problems for us as well.
Hey, Tom, it's Josh. When you heard Ben Bernanke testifying before Congress, some of the big worries he had, it was the European sovereign debt mess. It was also the fiscal cliff, though, Tom. How worried are you about that for here in the U.S.?
Unfortunately, we know it's going to be a source of volatility for markets. We just also know realistically Congress can't do anything until after November. So on the one hand, you really can't expect a lot. I just think the situation is very different than last year's debt downgrade because we're not facing a default at all in the U.S. On our U.S. Treasuries. We're really facing, I think, more likely a fiscal pothole, something where we're going to have a 1 or 2 quarter sort of period of turbulence. But ultimately, I think Congress gets something that's retroactive anyways.
Tom, great for you to stop by. Thank you for staying with us through the bell. Tom Lee, the Chief U.S. Equity Strategist at J.P. Morgan. And still ahead, Southwest Airlines stock is higher in early trading. We're going to get CEO Gary Kelly's take on those better-than-expected results and his outlook as well. And our exclusive Bloomberg Billionaires Index is missing a familiar face this week. It is him, Mark Zuckerberg. We'll tell you why. About 7 minutes now into the trading session, and we are seeing some pretty Strong gains here, at least for the Dow, up 32 points. Strong, relatively speaking, from what we have seen over the last several days. Now, technology shares, consumer discretionary, those are the two sectors leading the way. Don't forget, Microsoft, Google will be reporting after the bell. Now, I want to focus on one specific name that we have been watching this morning, Southwest Airlines. We learned that profits were up a healthy 42% in the latest quarter as the nation's largest low-cost carrier further controlled costs and also enjoyed lower jet fuel prices. That stock is up about 2% as I speak. Joining me now from his headquarters in Dallas, Texas, is Southwest Airlines Chairman, President, and CEO Gary Kelly, who is also a member of President Obama's Jobs Council. And Gary, I want to talk to you about the overall jobs market in a moment, but first, on your own airline and what you are seeing, what is the outlook for travel in the second half?
Well, first of all, we're delighted with our second quarter results. If you exclude special items, our earnings were actually up 140%. And really, these aren't moderate oil prices. These are very high energy costs. Brent crude oil, of course, is well over $100 a barrel. So it's despite the fact that we have high energy prices. We've got a pretty strong revenue environment, and I think we've managed our capacity well, and I'm just very pleased with the second quarter. The outlook for the third quarter is good. We have strong bookings in place. We have energy prices that are behaving themselves, if you will. So hopefully we'll have another strong quarter. The demand is good. July 4th holiday on a Wednesday is not very good for air travel. But taking that into account, again, we're pleased with the revenue trend so far.
Well, Gary, you mentioned oil prices, and yes, they are still, at elevated levels compared to what we have seen maybe over a year ago or a few years ago. But Gary, the prices have been coming down steadily month after month. There's been a little bit of a rebound recently. But when you're seeing lower oil prices as they're trending down, are you going to be able to pass that on as lower fares to your customers?
Well, again, they're not low. So if you compare it to a year ago, we're pretty much in line with where we were in second quarter. Oil prices are definitely down from where we were in the first quarter of this year. That's one of our more challenging aspects of the airline business is the volatility of energy prices. A lot of people are arguing that they're going to go higher this year and again next year. So that'll be a challenge for us, and we'll have to manage our business very carefully.
Gary, as I believe as I know, your airline pays, or your company, excuse me, pays a dividend. It's a small dividend, but you hiked it up back in May. Are there any plans? What are your plans with the dividend? I mean, could you even possibly suspend this dividend in order to put more cash to work, given so many assets that are out there for the buying?
It's all about hitting our profit targets. We had a very strong second quarter. If these trends continue, we'll have a very strong year, and it'll position us for a great 2013. Our return on invested capital target is 15% pre-tax. We're not quite there yet, but that will certainly, achieving that will put us in a position where we can consider continuing share repurchases, increasing the dividend, and we'll still have cash available to grow this airline. Because you're right, I do think there are going to be opportunities to grow, and we are aggressive, and we want to be a growth airline, and so we'll be well positioned for all of that so long as we hit our earnings targets.
Gary, I mentioned early on that you were part of President Obama's Jobs Council, and that is a 26-member council of CEOs from the two parties. Now, it's been noted in the press, and it's also been noted by Governor Mitt Romney, that this council hasn't met since January 17th. At a critical time when Americans want to know where the jobs are, why has this council not met since January?
Well, the council is led, I think, very ably by Jeff Immelt at GE, and pretty much accomplished its mission by delivering the report to the president last fall. So at this point, I think the administration is focused on obviously the work at hand, but also re-election. The economy, of course, is continuing to muddle along, and jobs are all about being competitive. And I think that was the essence of our recommendations: is we need to put into place more competitive enablers for the United States so that we can compete more effectively on a worldwide stage, and that's the way we're going to grow jobs in this country.
But Gary, I'm trying to understand how, with the jobless rate still at 8.2% and worries continue about the jobs market, how the council could perceive that its job is done.
Well, the council is simply a volunteer organization that was put together by the president, and we did what the president asked us to do. So we've delivered our ideas, and now it's up to the administration to execute those as it sees fit.
So if there's going to be a next meeting, it's going to have to come out from an invitation from the White House, essentially.
Correct. Yeah, we fulfilled our mission, and now it's in the hands of the administration.
Gary, thank you very much. I appreciate you joining me. Gary Kelly, the CEO at Southwest Airlines. And coming up, Drugstore Cowboy. We're going to take the temperature of Walgreens stock following its deal with Express Scripts announced just this morning. And will the market gobble up Chipotle's bottom line? We're going to take a look at the state of the fast food nation next. We are about 16 minutes into the trading session. Josh Lipton has an early check on the movers at the New York Stock Exchange. Josh?
Yeah, hey there, Betty. Three quick movers to highlight for you this morning. Let's start off with Walgreens, which is surging here today. Check out that move. The largest U.S. drugstore chain renewing a contract to provide Express Scripts customers with prescriptions, ending a dispute that contributed to an 11% decline in the retailer's quarterly profit. Also, Betty, keep your eye on Qualcomm, the largest seller of mobile phone semiconductors, futures gaining here after quarterly results showed customers in emerging markets are trading up to next-generation handsets. And finally, Nokia jumping hard. That's after sales of its flagship smartphone exceeded analyst estimates, signaling the former global handset leader is making progress with a plan to stem revenue and market share declines. Betty.
Josh, thank you. Now, Yum Brands reported their results yesterday, and profits missed analyst estimates due in part to increasing costs in China. A large part of their revenue profit comes from China. This afternoon, we're going to get another look at the consumer spending picture when it comes to dining out, and that is Chipotle Mexican Grill has been the subject of a lot of off-camera conversations this morning. Tom has been watching Chipotle, and you've got a preview.
Well, we got an interesting stock because it's one of the ones that you pay attention to because it's a $400 stock. Now, market cap obviously not that large in terms of the overall scheme, but take a look at this because the earnings estimates are going to be key here, Betty. $2.30. That's what the street is expecting in terms of earnings per share on an adjusted basis. That's on sales of $707 million. Now, the story around Chipotle is interesting because if you look at a chart, it is just off of its all-time highs. This has been a momentum stock for a lot of traders out there. You can see the chart there. We're 10% below that high that we saw earlier this year. Now, what it's going to come down to is whether or not the earnings growth can support it. When it comes to Chipotle, we're talking about a company, Betty, that got just about every red nickel of its income, its sales, from the United States at the end of last quarter. So this is not Yum. This is the antithesis, at least for now, of Yum Brands, almost all of it coming strictly here in the United States.
So it's almost if you wanted to hedge your Yum bet, then you would buy Chipotle.
Buy Chipotle. Now, it's also interesting because, remember, commodity costs, we've been talking about the things like corn prices right now, about how livestock prices are being affected by drought conditions. These may be things that we want to listen to on the conference call later on after the earnings report. But again, when you contrast it to Yum, remember with Yum, they cited rising costs in China as one of the main reasons why they missed their profit estimates. So you want to watch what happens with Chipotle after the bell today.
Very interesting. Dom, thank you. Still ahead, we're going to tell you all about a reversal of fortune for Facebook founder Mark Zuckerberg just 1 week ahead of the company's first ever earnings report, public earnings report. Back in 2.
See senior management at some of these firms start to look at how they're actually structured. Take equities, for example. The amount of job functions that exist in sales. You've got a sales trader. You have a portfolio sales, research sales. Now you have a regular trader. You have publishing research analysts. You have non-publishing analysts. You have capital markets. You have syndicate. There may just be too many jobs, and we could see a lot of them consolidated in the next year. If you think about it, these derivatives businesses that are getting shut down, well, those jobs may not exist. You may not see separation of derivatives and cash businesses. And remember, structurers, if you don't have any structured business, you don't need any structurers. We could see jobs just get wiped out here completely.
I think this is an excellent question, Stephanie, to pose to our friend of the show for today. It's Christine Harper. She is the chief financial correspondent at Bloomberg. Christine, you know, it's a legit question, don't you think? What's the business going to look like a year from now? What's the business going to look like 2 years from now?
And what's going on right now is all these management teams are desperately hanging on, hoping they don't have to make those kind of radical changes, even though shareholders in some cases are really eager for them to see them. What these management teams are hoping is that somebody else goes first. You know, what J.P. Morgan and Goldman would love to see is for Morgan Stanley to just start getting out of fixed income so that they could take that market share and then they don't have to cut as many jobs. That's what people are waiting for. Is anybody else going to exit? Or, you know, maybe some of the Swiss banks going to slim down their businesses, get out of investment banking, give more business to the rest of the street? Or are you going to have this continued situation of the whole street, every single firm having to cut down their business?
But what about the fact that the street, the sell side, moves much slower than, let's say, the buy side? And you talk about management teams, maybe it's that there are too many managers. If I run a derivatives business, well, I don't want to merge my business with the cash business, because guess what? Maybe the guy who runs the cash business will get all the beans here. So
right.
Does it seem like these banks may start following the client side, where things have already, you know, have merged much more closely?
Well, you know, the client side, a lot of those people are managing their own money. The difference on the sell side is they're managing other people's money. I mean, if they have, what is Morgan Stanley's return on equity is ridiculous.
3.5%.
I mean, how many managers of their own money would really be happy with that? The reason these guys keep giving is it's going to get better. There's too much capacity in the system right now for the deal flow we have now, but if deal flow picks up, we'll be really well positioned, you know, or else maybe European banks will get out. You know, they keep hoping somebody else will get out. It's like a game of chicken. Eventually, we'll see what happens.
Christine, on the subject of fixed income trading specifically, it was just 18 months ago, right, that the viability of Morgan Stanley's fixed income trading franchise was being questioned. James Gorman brought in Ken DeRate to run fixed income, third guy in, what was it, 5 years or something like that, who ran fixed income. And the question stopped. Surely they've got to start up again.
Yeah. No,
I mean, is it possible, I guess what people are going to be asking, is this firm past the point of no return?
Well, I was talking to Charles Peabody at Portales this morning, and his point was, you know, basically strength begets strength and weakness begets weakness. And what you're seeing with the Morgan Stanley's fixed income franchise is they're just weak, and they're likely to get weaker because in part because of this, you know, they've got this issue with their Moody's rating. You know, people are demanding more collateral. It's harder for them to make
more expensive for them to trade, right?
I mean, Ruth Porat, the CFO, is on the call today talking about some of their fixed income businesses maybe not being necessary. So they're, you know,
are they getting it by choice? No, they're being forced out either by regulation or they're being forced out by scale, perhaps,
because
right?
they have to, because their shareholders aren't going to put up with it. I mean, think about Morgan Stanley has literally been telling shareholders for how many years, wait and see. But this year is going to be the execution year. This is the year, you know. So the first quarter was this, you know, everybody got very optimistic. It's coming through. This is so devastating on that front.
But isn't this extraordinary? Look how Morgan Stanley has fallen since the crisis. If you think about who Morgan Stanley was in the early 2000s, the Morgan Stanley, Goldman Sachs type Americana brand, I mean, these are the banks people wanted to do business with, people wanted to work with.
And they still have strong equities franchise. They still have a very good M&A franchise. They still have areas that they're good at. The question is whether they say, fixed income is not working out for us, maybe we don't need to be in that.
But can you completely get out of a business like that? Wouldn't that affect, I mean, if their M&A business is so strong, on the heels of great banking business, will strong debt deals come? Can you really suddenly say to your clients, well, we don't actually offer fixed income solutions anymore?
Well, there's a lot of boutiques that do exactly that. So.
Makes me wonder, though, if, I mean, to give Gorman and his team the benefit of the doubt, maybe, right, it's just, as they like to say, one bad quarter. And, you know, maybe, no. I mean, we can ask the question because there are other parts of the business, right? The big bet on the brokerage business, okay, maybe it isn't hitting the ball out of the park,
right,
but there's some steady improvement there. So if that continues to improve, maybe if there's a turnaround on the trading side and if they can continue to hold their own in equities, which they are, and if they can continue to hold their own in investment banking, they are.
I asked Charlie Peabody whether he thinks there's going to be any management changes required out of this quarter.
But what's the manager going to do?
He said, well, you know, I mean, it just makes somebody accountable for their underperformance. He said, no, he doesn't think so. He thinks basically the market is going to give some rope to these guys. You know, the conditions are terrible. Think about it. Most of these banks are preparing for a breakup of the euro. I mean, it's hard to be taking lots of risk in your business if at the same time another team is out there preparing for like worst case scenarios. They're very.
I mean, we've put the question to Gorman himself on any number of occasions, and he has said, I'm really happy with my management team.
Right. So I'm not very convinced they're going to do anything drastic just because the environment is bad. They can chalk it up to the environment. They can point out that a lot. I mean, you know.
But if you get 2 or 3 quarters like this.
But also remember, 2008 wasn't that long ago, and clients don't forget. Morgan Stanley's prime brokerage business pre-2008 was the best out there, and now it is a shadow of what it once was. And hedge funds do not forget. They remember getting their lines pulled in 08. There were hedge funds that went under when not necessarily went under when Morgan Stanley came knocking, but when the whole street did. You can't build that back overnight, even over a few years.
Christine, what does it say to the world, effectively, to governments, to regulators, to clients, to even the general public, that the firms, we talk about this quite a lot, right? The firms that were supposedly doing the right thing, the Morgan Stanleys, the Credit Suisses, backing off risk-taking, becoming the client-focused franchises, are doing the worst. What does that say?
And that's an excellent question, Eric. I mean, how much of it do you chalk up to that strategy? How much do you say it's because they just haven't really convinced clients they can do the business that they are?
Or maybe they don't have the right people? These are all questions that are tough to answer.
Yeah, so I mean, that's, one of the things is Morgan Stanley went on this big hiring spree of trying to bring in fixed income talent. Maybe they didn't hire the right people.
They've brought in so many people, Eric. I mean, I think it would be tough to, and who's really going to go there now without a big guarantee? Right. Could Morgan Stanley actually say to their shareholders, we're going to fix it by bringing guys in on big 2- and 3-year deals? Give me a break.
Yeah,
no, unquestionably that's not going to happen.
Yeah.
Christine,
thank you.
Great to see you, and thank you for joining us. That's Christine Harper. She's the chief financial correspondent here at Bloomberg, talking to us about Morgan Stanley and the streets. Some enormous questions we'll be answering with Brad Hintz and Tom Joyce a little later in the show. Now that we've set the table for you, let's dig in a little further. Dominic Chu is over at the touch screen. Our top headline: soybean crops surge to a record as the U.S. drought intensifies. Walgreen, one of 3 stocks you need to watch, and Bill Ackman is our market maker today. Dominic, take it away.
Well, let's talk about the scene setting, because you were just talking with Christine Harper about this idea that Morgan Stanley is a huge concern for a lot of investors, even traders and people who have jobs on Wall Street right now. Let's take a look at what's going on with Morgan Stanley shares overall. You can see they're down 5% on the news that they missed in terms of their analyst estimates, also showing, again, signs of the weaker trading environment right now. But from financials to technology, a huge company that you're going to want to watch throughout the course of today is going to be Google, up about 2% right now. It reports its numbers after today's closing bell. So tech and financials very much in focus. Now, this particular tug of war also playing out in the markets right now. Scarlett was talking about that negative trifecta of economic data at the top of the hour. Existing home sales, Philadelphia Fed, leading indicators, all coming in worse than economists' estimates. You can see that playing out in the markets right now. S&P flat, Dow Jones flat, NASDAQ marginally higher here. But more importantly, you've seen a momentum shift to the downside for the S&P 500 just in the course of the last few minutes here. You're going to watch and see how that plays out in the next hour of trading or so as we head towards midday. On the Treasury side, same kind of thing here, 1.49%. So still 10-year U.S. government bonds hovering around that 1.5% yield for 10-year U.S. government notes. On the Euro side, watch what's happening there. Some weakness in the euro versus the U.S. dollar. It'll now cost you $1.2234 to buy 1 euro. And on the commodity side, New York crude, it was inching towards 90. Now it's above it, 91.22, 91.32. The last trade there, some real strength in this stealth rally Tom Lee at J.P. Morgan calls it in terms of the oil or energy sector rally. Gold futures also 1580, still below 1600. So for right now, Eric, it looks like, yes, energy prices going higher, but the market's not exactly following suit right now.
Dominic, thanks for the update. That's Dominic Chu over at the touch screen. It's time now for our Bloomberg top headlines at this hour. And here's Sarah Eisen. Sarah.
Eric, that investigation into LIBOR rigging has now turned to traders at 4 more banks. According to a person with knowledge of the matter, traders are being investigated at Deutsche Bank, HSBC, SocGen, and Credit Agricole. Deutsche Bank and SocGen and Credit Agricole say they're cooperating with the probe, HSBC not commenting. Get ready for higher food prices. Crop prices are surging today thanks to the worst drought in more than half a century. Soybeans hit a record. Corn reached the highest level in 4 years, and so did wheat. Almost 1,300 counties in 29 states have been declared disaster areas because of the drought. And Hollywood is expecting a blockbuster opening for The Dark Knight. The third Warner Brothers movie starring Christian Bale as Batman may bring in close to $200 million this weekend, which would be the second best opening ever, right behind Disney's superhero film, The Avengers.
back to Market Makers. I'm Stephanie Ruhle, and we're back with Sanford Bernstein's Brad Hinson. We're going to turn our attention to the LIBOR scandal. Now, Brad, you don't just cover Morgan Stanley, you cover a number of banks. How massive is this? Can we even quantify the ramifications of this LIBOR situation and how it's going to affect these banks and the market?
You can. You know, it's not perfect, but you can look at the size of the market that is affected, priced off of LIBOR, right? And it's about 30 trillion of loans and about 300 trillion in the fixed income market in derivatives. Now, how big could a LIBOR manipulation be? You know, all the headlines have talked about that brief period of time when the markets were liquid and LIBOR was clearly being mispriced. But the reality is, if we think of what Barclays disclosed in their CFTC or their FSA discussion, they said that they attempted to manipulate LIBOR as early as 2005. Well, that would mean that the manipulation was relatively small because, you know, the money brokers in London, as you well know, are hardly a gentlemanly group, right? And
there's no Eric Schatzkers.
Well, that's right. And so you know, if you as a money broker thought I was manipulating LIBOR by a lot, would that have been outed? Of course it would have. So could I manipulate LIBOR by a lot? No, I could only manipulate it by a little bit. So it strikes me that a reasonable way to think of a LIBOR cabal would be minor manipulations of LIBOR. Do that. We did the analysis of a 1 basis point manipulation of LIBOR. 1 basis point manipulation of LIBOR, time the size of the market, 4.5 years, a capital charge, or pardon me, a margin on that, and you end up, and then the standard
It's a distortion of how much?
And it ends up being the equivalent of 2 Enrons.
Wow.
In terms.
Leisure activities may be shifting from going overseas to maybe eating out in Japan. A large percentage of consumption has also been shifted into healthcare. So Japanese healthcare, while it's nationalized, a larger and larger percent of it needs to be paid for by the individual. So maybe 10 years ago, I can't remember the exact numbers, maybe it was 10%, now it's 20%. So your consumption patterns are actually shifting more with your age.
Right. So the elderly are still saving, but they are spending on certain things like health care. Are they spending on leisurely activities at all? Can you take advantage of that?
Well, I think they're certainly spending on, you know, the ability to go out and eat more readily, cheaply. And people think Japan is a very expensive place, but housing may be expensive, but
prices have gone down.
Deflation has been a boon for, you know, people who have a little bit of disposable income and can go outside and enjoy it.
Right, it's easy to forget that. The argument against buying anything in Japan is that it's a value trap and monetary policy is largely ineffective. How then do investors unlock that value?
I think it's very difficult for the average investor to unlock that value. Symphony's been successful because we have a team that is not only value-driven, but kind of results-oriented. We have more investment banking expertise than just analysts. So we work with management to unlock that value. If you just look for...
You're proactive investors.
We're very proactive investors, but we work with management. We're not hostile. We're not activists. We're trying to help unlock the value that's there. And if management doesn't want to do it, then we move on to the next name.
There's always someone else.
There's so many cheap companies. You realize there are over, thanks to Bloomberg, over 220 companies that trade at 100% net cash to market cap today. So you're spoiled for choice when it comes to value. The issue is, when will that value be unlocked? And our proposition is that it won't be unlocked unless you take a proactive role.
Okay, let's broaden this out to the rest of Asia. You see evidence of a growing wealth dynamic throughout the region, right? What is the distinction between, say, China and India?
There's a huge distinction between the two.
What is the main one?
Well, I think the main one is, India is, quote unquote, a democracy, and getting things done requires consensus. Whereas in China, if China wants to build something, they build it. We'll move everybody from one part of the city to the next, or we'll move people from the countryside into the city, and it gets done. And I think India has had a very difficult time being able
It takes more time to get that done, but they'll get there?
I hope so. I'm not sure they're going to get there.
All right. Thank you so much. David Barron, co-CEO of Symphony Financial Partners, visiting us from Tokyo. Coming up, expanding your investment vocabulary with Bob's buzzword of the day. It is debt valuation adjustment, also known by its acronym DVA or sometimes CVA. It helped account for almost half of Morgan Stanley's reported income, even as profit dropped. We'll tell you why coming up next.
years per year. That's what you're going to get. You're going to get your money back when you're done. That's what you're going to end up with.
Less than the rate of inflation, which is your point. The dividend yield, however, 2.64.
Correct. So 2.64 is higher. Not only that, but it's been growing. You've got a stock that's trading at 10 or 11 times earnings. We'll see tonight after the close what kind of a number they hit this quarter. But the point is, if you had to take two pots of money or a pot of money and put it into one of those two sides, which would you pick? I know I'd pick the stock market. You're getting a growing dividend stream, and you get the price potential rather than 175 basis points on bonds.
Understood. Another one, Procter & Gamble. Walk us through those numbers.
Procter & Gamble, same deal, right? You've had a stock that's been underperforming. Certainly, Ackman is starting to agitate a little bit there to get the stock price going. 10-year bond is 2.3%. Very, very, actually relatively widespread for Procter & Gamble compared to the dividend of about 3.5. So here you're picking up 120 basis points or so per year. You compound that over 10 years, and with a little luck, you get some price appreciation in Procter & Gamble. To me, it's a no-brainer.
And finally, GlaxoSmithKline.
Glaxo's a little different company. It's European, so it has a little higher yield, actually. It's a little lower valuation than some of the others. The bond trade's pretty tight to P&G. It's 237. But you get, what, 475, almost 480 on the dividend yield. And again, that's been growing about 4, 5, 6% per year. So you're going to end up with a much bigger, in my opinion, over the next 10 years. So this isn't saying that any of these three are the best investments. It's really comparing and contrasting the bond yields that the market's pricing for these folks with their current dividend yields. And very different risk profiles, all the rest, all the right disclaimers. But at the end of the day, I think it's an interesting investment idea.
Awesome insight. Michael Vogelsang. Alex?
All right, and just ahead from tobacco to tech, we've got every stock you need to know coming up in our top 10. We'll be back in 2.
And Walgreens shares are up about 12%. The largest U.S. drugstore chain renewing a contract to provide Express Script customers with prescriptions. The stock surging the most since 2008. This is a big deal, and it was one reason not to buy Walgreens for a lot of people for a very long time. Alex?
Contributed over $5 billion to annual revenue for Walgreens. All right, number 9, United Health shares down about 2% today. The biggest U.S. health insurer boosted its profit outlook for this year on the strength of rising enrollments, but the percent of premiums the company spent on customer care was little changed.
Number 8 is Verizon. Those shares down about 3%. Second largest U.S. phone company reported a 19% gain in profit after larger mobile phone bills helped make up for sluggish growth of its landline business. The stock is up, though, about 13% so far this year. So maybe buying the rumor, selling the news.
And let's talk about Philip Morris shares. Well, they are roughly flat right now. Look at that, up just 13 basis points. The world's largest publicly traded tobacco company reporting second quarter profit that beat analyst estimates. Growth was spurred by demand for cigarettes in Eastern Europe.
And number 6, eBay. Shares up about 8%. The world's largest internet marketplace reported sales and profits that beat analyst estimates as more U.S. consumers shopped for new items on the site. CEO John Donahoe has increased spending on advertising and new technology.
Number 5 is Five Below. Shares up 58%. The teen retailer whose goods sell for $5 or less rose as much as 55% in its trading debut after pricing its initial public offering at the top end of the range. Then it jumped to 58%. And by the way, you can buy other stuff there than just, I don't know if it's really a teen retailer, right? Because you can buy stuff for the pool, sporting goods, you can buy bracelets, obviously you can buy stuff for your iPhone.
Matt, I'm impressed. You sound like a fan. You also sound like a shopper.
Anything that costs between $1 and $5. No, because I listened to Pim Fox on the radio, like basically list the entire contents of the store this morning, so I know what you can get there.
Michael Vogelzang on IPOs. What's your take in general right now?
The IPO market needs a healthy, really strong underlying equity market to really succeed. That's when demand is high. That's when people are looking for more speculative ideas. Right now, we've got a high-quality rally going. I think the IPO market's going to stay in the box for a little while until we get a little better market price in the stock market.
And every now and then,
today.
Yeah, very true. And every now and then, you get something that shoots up. Facebook, of course, being the opposite example. IBM, speaking of shooting up, shares up right now about 3%. The world's largest computer services provider, raising its full-year profit forecast. The company's shift towards higher-margin software has helped it to overcome the slowdown in overall tech spending.
And from a winner to a loser, check this out. Morgan Stanley shares down about 5%. The bank reported a 50% drop in earnings and said it will cut more jobs as revenue from trading stocks and bonds declined. The firm has already cut over 3,000 jobs since the start of 2012 and expects that number to climb by 4,000 by year end. Wow.
Number 2 is Microsoft. Those shares up about 0.5%. The maker of Windows software due to release earnings in just a few minutes. Analysts are expecting earnings of 62 cents a share compared to 69 cents a share last year.
There you have it. And you know what it's time for? And there's the drum roll. Guess that you got it. Google, the #1 stock today. We'll see if it can hold that position. Shares up 2% right now. The company releasing earnings just moments away. Analysts are expecting earnings of about $10.09 per share. That, by the way, compares with $8.74 a year ago. There also is the closing bell. We finished the day up 33 points and a real tug of war today, Alex. We've been down, we've been up, we've been down. Economic data on the one hand, earnings on the other. Economic data not so good. Earnings have been pretty solid.
Yeah, if you look at the S&P, up about 3 points. It's 3 days of gains, 1376. But, 1375 is a key resistance. And what happens when you reach resistance? You tend to test it on a lower level. So we'll see if that plays out tomorrow.
Hey, good point. All right, let's go right down to Matt with the details on the close. And Matt, the way traders were playing it coming into the close and certainly ahead of a lot of earnings after the bell.
Yeah, definitely people were buying this market into the close, maybe selling off a little in the last few seconds. Up 33 points, 12,942. The level there. The S&P putting up a gain of a couple of points here, almost 4, 1376. The NASDAQ, the biggest gainer of the 3 major indexes, up 0.8%, 2965, 2966. Because those tech stocks really leading the way. IBM, as you pointed out, one of the biggest gainers today, the biggest percentage gainer on the Dow. And people like the tech earnings story, regardless of Qualcomm tapering its forecast, regardless of what you saw with the commodities players like AMAT, Advanced Micro Devices, etc., Intel, to name one more. They really like what they're seeing this earnings season. It's better than expected, although it was lower. The bar obviously had been lowered going into earnings season. And frankly, there's the kind of perverted, if the economic data is bad, like what we got this morning, sort of disappointing on every single point, then maybe